Hello and welcome to Market Domination Overtime. Stocks closing lower amid renewed trade tensions, and our very own Jared Blickery has the latest. Jared.
Thank you, Josh. Worst day for the Dow, NASDAQ Composite, and S&P 500 in 3 months. You'd have to go back to October 10th, I believe, for that one. Here is the Dow Jones intraday, down 870 points into the close, 1.76%. And you can see it kind of flatlined over the last 2 hours. Could have been worse, not a total disaster, but nevertheless, not a great day. Here's a NASDAQ down 2.4% or 561 points, and the S&P 500 a little bit less than that, 2%, 2.06%, but I haven't seen one of those in a while. Russell 2000 down about 1.2%. Remember, they were outperforming, the small caps and the mid caps outperforming last week, and I guess they're still outperforming today, just everything kind of in the red. 10-year T-note yield, this is material because the yields, the long-term yields are perking up. That was up 6 basis points to 4.3%. The 30-year up to 4.92%. 8 basis points was a gain for the day. And a reminder, when it gets close to 5% and a little bit beyond, that has spelled trouble for equities. And that's what we're seeing today, where in large cap land, only XLP, that's consumer staples, was in the green, up about 1/3 of 1%. The three that were down 2% or more, tech, consumer discretionary, and financials. Just a reminder, we got financial earnings ongoing here. I'll add to that, industrials also down 2%. And let's take a look at NASDAQ 100. You can see some of the carnage in the mega caps. NVIDIA up in the upper left there, that was down 4.3%. Tesla down over 4%. Broadcom down towards the bottom, down 5.4%. And then Apple and Amazon each off more than 3%. If we take a look at the semiconductor board, we do see some green here, but the larger ones tend to be the ones suffering the most. So this has been a sell the large caps. And then in software, just about everything getting sold, although a couple names slightly in the green, nothing to write home about. I want to show you the Dow, and you can see a little bit more green on this board. Some of the healthcare names like United Health up 2%, Merck up 0.6 of 1%, even Boeing, an industrial name, up 0.5%. And then you got the staples. That was your safety trade last week. And also this week, Procter & Gamble up over 1.5% and Coca-Cola up 1.87%. Josh.
All right, thank you, Jared. Now taking a look at commodities, gold and silver surging to new records amid President Trump's pursuit of Greenland. Our very own Ines Ferre has the latest. Ines.
Yeah, Josh, and if we take a look at gold futures today, up above $4,700 per ounce, $4,763 to be exact right now. And silver futures also touching the $95 level earlier today. The debasement trade, as one analyst put it, is on fire, and precious metals are the outlet. And this, of course, has to do with Greenland. When it comes to gold, also central bank buying, high fiscal deficits, and basically the theory that, well, the only way to get rid of those is to inflate away the debt. And so that's why you're seeing this sort of debasement trade, this massive rally that we've seen with the precious metals. One, though, analyst noting from Saxo Bank, watch out, because at some point, especially when it comes to silver, when you're looking at this, look, year-to-date rally up 33% for silver. This is after last year was up around 150%. At some point, demand destruction kicks in. And also taking a look at where we're at with Bitcoin, that has seen a move lower today. I'm going to pull up the Bitcoin chart so you can see Bitcoin, Ethereum, weakness that we've seen with cryptocurrencies recently. Bitcoin down more than 3.5%, trading at around 89,500 per token. A 10x research note that just came out this afternoon, basically watching for the $87,000 level. They're basically saying if you go below that, then they could reverse their strategy there. But right now, holding up above 89. Josh?
Thank you, Inez. Appreciate it. Well, Netflix fourth quarter earnings just now crossing the wire. The stock is down, got about 3%. Let's get you those numbers. Netflix Q4 EPS 56 cents. I do not see a straight compare there. Q4 revenue 12.05 billion versus an estimate of 11.97 billion. Q4 free cash flow 1.87 billion versus an estimate of 1.46 billion. Turning ahead, what they see, Q1 operating income 3.91 billion versus an estimate of 4.18 billion. So that's a bit light. Q1 revenue 12.16 billion. The street was 12.17 billion. So that's basically in line. Q1 operating margins, they're calling for 32.1% versus an estimate of 34.4%. So undershooting consensus there. For the full year, they see 2026 revenue, they're calling for between 50.7 billion to 51.7 billion. The street was closer to 50.96 billion. So it does look, at least initially here, we're down nearly 4% in the after hours. Remember, the stock, since Netflix has last reported, that was October 21st, it was down around 30% from then because there had been these concerns about the fundamentals here with Netflix, the kind of growth trajectory for the company, the organic levers this company was going to be able to pull in light, of course, of this big headline-making transaction for WBD. Netflix, of course, did make some news on that front today, saying it sweetened its bid with an all-cash agreement there. But initially here, disappointed by investors with the stock down about 4% in the after hours. Well, for more reaction to Netflix fourth quarter earnings, we're bringing in Geetha Ranganathan, senior media analyst at Bloomberg Intelligence. Geetha, I want to obviously get your thoughts on this WBD transaction, the latest news there. But why don't we start on this print and give me your take, Geetha, on the report. What do you make of it?
Hey, Josh, thanks for having me. So 4Q numbers look really solid, but I agree with you that the first quarter guidance looks a little bit light. But you zoom out to the entire year guidance, so 2026 revenue guidance, the magic number that we were looking for full year revenue guide was somewhere at around 13%. I think at the higher end of the range, Netflix is suggesting about 15%, so definitely much better than what consensus was expecting. But I think where they're falling short is the operating margin guide. So Netflix, I think, suggesting something like in the 31% range, whereas consensus and investors were looking at something like at about 32 to 33%. So still some questions to be answered on the operating expense front, whether the expenses are growing a little bit faster than what was initially expected, or whether this is just the impact of the Brazil tax, which we saw, the catch-up tax, which we saw last quarter, and whether it's just an extension of that. So some of those answers still to be gotten.
Some questions, Geetha, but I guess, listen, we're in the red in the after hours here. Since they last reported in late October, Geetha, this stock was down around 30% because, as you know, and you've written about it, there have been these concerns among some, investors about the fundamentals with Netflix, Geetha, about the growth trajectory for the company. I'm just wondering, when you look at this print, what line of sight you have into those broader questions.
Yeah, so I think the number one thing for Netflix management is going to be the engagement number. And this has really been the constant concern, Josh, whether the slowdown in engagement is what prompted the $83 billion deal for Warner in the first place. Now, looking first flush, you look at the 4Q numbers, they look really strong. I'm sure subscriber growth was really strong. Of course, they don't report subscribers anymore, but you just kind of look at the revenue numbers, you look at the operating margin numbers, everything looks pretty good. The real question is going to be 2026. And I think the big question here is whether they're going to increase prices, just kind of amidst this regulatory scrutiny, right? Are they willing to take the risk to raise prices and kind of be branded, maybe not so pro-consumer, especially as regulators kind of really, weigh down on the deal? So still a lot of questions there. But I think some of the high points were that they still are looking at advertising as being a big growth catalyst into 2026. So they're talking about ad revenue doubling in 2026 versus 2025. But again, more directional, and I'm not sure they've given us the exact numbers just yet. So it's still a little bit difficult to figure out, what the base is. But overall, I would say results are pretty strong.
Geetha, what is Netflix going to spend on content in the year ahead? And what's the content in the pipeline, Geetha, that you say, okay, consumers and investors, would be excited about?
So there was a lot of content to get super excited about in 2025. I mean, you had some of their hugest hitting titles. I mean, whether you're thinking about Stranger Things or Squid Game or Wednesday, these are, some of their biggest names. So those hit in 2025, and Netflix management team obviously repeatedly referred to 2025 as an embarrassment of riches. Now, I don't think they're necessarily going to have the same benefit in 2026. Yes, you do have a couple of, big returning titles, whether it's the Diplomat or the Night Agent or Bridgerton. All of those, of course, will move the needle, but not as significantly as it did in 2025. But what we're seeing in 2026 is that Netflix is making a much bigger bet into sports. So we already saw, the NFL Christmas Day games obviously brought in some huge viewership numbers for them. The Lions-Vikings game was actually one of the most heavily streamed game, ever in the history of streaming. So obviously very encouraging metrics. And I think that really kind of bodes well for them to make this bigger, bolder bet into live and live as well as sports content. So that's what we're going to see in 2026. But again, the slate not as blockbuster or as stellar as we saw in 2025.
Geetha, Netflix, we heard today, they did sweeten their bid for Warner Brothers Discovery, all cash agreement. Do you think that, Geetha, now increases the chances that Netflix gets this deal done?
They're definitely trying to get it on a fast track here, Josh. So one of the reasons there was to kind of really, assuage investors about the declining value of the stock. So there's a lot more financial certainty for investors. And then, of course, they're getting to speed up the shareholder vote, which, if they had not done this, shareholders would have likely voted on it on the deal in June. Now this is going to push it up to April. So definitely speeding things up and kind of really putting the ball in Paramount's court, so to speak. Paramount now really has to come up with some kind of a response. Either they sweeten their bid or extend the tender or simply walk away. So we'll have to wait and watch.
Geetha, how confident, in your opinion, should Netflix be that regulators approve such a deal? Because, of course, Paramount argues it's anti-competitive.
Yeah, there is still, it's kind of a little bit of a black box there, Josh, because it looks from the initial looks of it in the US, it feels like regulators might actually give them some leeway, just because they're arguing that, it's not just that they're competing with Disney Plus or Paramount Plus or Peacock. They're really going up against the YouTubes of the world, the TikToks of the world. And so that's really how they should be viewed in the context of the entire market. Now, it gets a little bit more hairy when you get to other markets like UK and some of the other European territories where it looks like they have much higher concentration. So antitrust risk definitely can be a huge problem in some of the European markets. So it's going to kind of be a market by market, and it's going to be a tough, long slog, in my opinion.
Geetha, always lucky to have you on the show. Thank you so much for joining us. Appreciate it.
Thank you.
Coming up, we'll bring you United Airlines earnings. That's on the other side of the break. United Airlines is out with its fourth quarter results. Let's look at those numbers right now. You can see the stock popping about 2.5%. United beating consensus, it looks like, for fourth quarter. Adjusted EPS for the fourth quarter, $3.10. That was better than what the street had been looking for. Consensus was closer to $2.92, it looks like. Full year earnings per share for 2026, they're looking for a range of between 12 and 14. The street was closer to 13.06. The stock right now up about 3%. Over the past 12 months, it has not done a whole lot. It's actually down about 2%, though it looks like most analysts are still fans of this one. Most have a buy on this name. The average price target looks to be about 131. Comes after Delta reported as well. And we're going to get a look at both those results and talk about the industry more broadly as well, with a closer look with Third Bridge Global Head of Analysts. That would be Peter McNally. Peter, United just reporting here. Give me your take on the print. What did you make of those results?
Well, it was a nice conclusion to what was kind of a pretty wild year in 2025. I mean, a lot went on to have the stock just move 2%. We had the whole tariff thing in April, and the entire airline industry pulled their guidance except United when they weren't sure, and United gave this downside scenario that ultimately didn't come true. It turned out to be a pretty good year for United. Revenues grew, profits contracted a bit, but that wasn't unexpected. there had been some fears that the air traffic control issues at Newark would weigh on United. They got through it, like they did, and they delivered. And they've been, on the forefront of this trend of premium travel. It's been the big driver for United and Delta, and they executed. So it was a lot of work in between to kind of stay flat on the shares. 2026 shaping up to be, a pretty good year. But we'd be looking at Boeing actually as a big determinant on how United's gonna go from here. They're expecting more planes to come in next year to deliver further revenue growth. They're more efficient planes. They allow more premium passengers to get on board. So that's how we see it.
Let me ask you, as you mentioned there, investors pay very close attention to premium and international demand. I'm just curious, what do you see there? What are the trends now and ahead? And on the international side, Peter, could it get rocky, do you think, just given recent headlines with Trump threatening new tariffs?
Well, I think what we learned in 2025 is that Americans will still go abroad. Okay. We heard out of the European airlines that there had been this hesitancy for Europeans to come here, but that weighed on, carriers like Lufthansa and British Airways, and not so much United, Delta, and American, who are still flying Americans overseas. Okay. So that likely, still holds up in our view. The premium, yes, they're getting some competition, right? And even Southwest is now starting, you can reserve seats and they're offering, more premium economy, but it's going to take a long time to turn that fleet so that they can really be competitive with the likes of Delta and United. In the meantime, both Delta and United are being pretty aggressive. I would say Delta a bit more so recently with their CapEx and getting new planes. So they're really in a great position, today for what we see the airline industry, or at least the U.S.-based airline industry, doing going forward.
What do you think is going to happen with pricing at United, Peter? For those of us who have, got to book some domestic trips in the months ahead, what are we potentially looking at?
Well, the whole industry is actually geared up for growth in 2026, and there's some kind of punchy expectations. Now, some of it has to do with the slowdown or the slower growth that we saw this year, but street expectations are mid to high single digits, across the board, and some of that is pricing. Capacity is coming back. Capacity was more of a tailwind in 2025 as Spirit went bankrupt twice, so like that unwind took some capacity out, but it may prove to be a little bit more of a headwind in 2026 with some potentially softer pricing.
Let me ask you, when we talk about airlines, we're talking about labor costs often. What do you see there for United? Because I did see some analysts who cover the name heading into the print. They were calling that out as a potential challenge for United.
Well, I think, the industry went up and kind of stayed there, right? During the big inflationary period of 2022, 2023, a lot of these negotiations, took place. There were threats of, strikes, and, the industry got 30 to 40% wage increases like during that period. So we don't see it that much as a 2026, headwind. But as these contracts roll off, we see more of a, potential threat in 2027.
Peter, I also have to ask you, my friend, about this New York Times article this week. I don't know if you saw this one, but I'll read you the headline, get your thoughts. Here's the headline, Peter. Caught my attention. It says weight loss drugs, Peter, they're referring to, the GLP-1s. Yeah. They could save U.S. airlines $580 million per year. The New York Times is citing here this study from Jefferies. They say a surprising perk, they say, lower fuel costs as slimmer passengers lighten their aircraft's loads. I mean, fuel, of course, it's among an airline's, biggest expenses. So I don't know, Peter, what do you make of that? Is that good news for airlines and folks who invest in airlines?
It is, look, I haven't done the math myself on what those savings, might be. I understand where they're heading, but I would say two things. Number one, fuel costs affect all airlines the same. Okay. It's a commodity that goes in. But two, the outlook for oil is softer. Prices were down in 2025. I think the consensus is that the oil market is well oversupplied. So you're probably getting a double benefit from less fuel consumed by lighter passengers and just the general decline in oil prices leading to lower jet fuel, in the next couple of years.
Peter, great to have you as always. Thank you, sir.
Good to see you.
Time now for what to watch Wednesday, January 21st. We're going to start off in Europe. Investor attention is turning to the Swiss Alps as world leaders and top executives descend on Davos, Switzerland for the World Economic Forum. President Trump set to speak Wednesday, addressing affordability in the housing market, including a proposal that would allow Americans to tap their 401ks for down payments. This is coming as Trump turns up the pressure on Greenland, threatening new tariffs if EU countries don't support his push for American control of the country. Over on Capitol Hill, the White House's feud with the Federal Reserve heads to the Supreme Court. Oral arguments are scheduled for Wednesday in President Trump's bid to fire Fed Governor Lisa Cook. The hearing could have implications for the president's frustrations with Fed Chair Jerome Powell. And turning to earnings, we've got another big week of reports here, including Johnson & Johnson on Wednesday, the consumer staple company announcing results for the fourth quarter before the markets open. The company releases its first forecast for 2026, but analysts not expecting any big surprises with 6% earnings growth compared to 2025. And moving over to housing, we're getting some pending home sales data on Wednesday. Economists forecasting fewer contracts signed in December compared to the month before, signaling a loss of momentum in the housing market to finish 2025. That's going to do it for today's Market Domination Overtime. Be sure to come back tomorrow at 3 p.m. Eastern for all of your coverage leading up to and after the closing bell. But don't go anywhere. On the other side of the break, it's asking for a trend, and I've got you covered for the next half hour with the latest and greatest market-moving stories. Stay tuned.